This is TreppWire Week in Review for week ending December 9th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. And joining us today is Robert Jordan, Head of CMBS. This week, Treasury rates moved higher Thursday while investors tried to assess the economic outlook with a few more data points before the Fed decision next week. In economic data, November's stronger than expected jobs report was followed up with data that showed a growing services sector last month. Manus, we've got a few more data points we're going to see in the coming days. We've got the wholesale inflation number, consumer sentiment, and next week we've got CPI. But for now, the central bank is looking at a relatively strong labor market.
It's funny how this market and investors and money managers and so forth just seem to be running from one side of the boat to the other. Right. A week or two ago, it was all risk on, and everybody was convinced that rates were going to fall and the worst was behind us on inflation. And we saw a mega rally, and everybody was high-fiving and really looking forward to 2023. And then without a whole lot of new data other than really just the jobs report last Friday, we've gone from rates are falling and things are great to rates are falling and a recession is coming and the sky is falling too. And as we saw 5 straight days of losses to the S&P over the last couple of days. The tone has become negative. Several bank heads, including Diamond and others, have come out and said 2023 is rocky. The consumer is going to be tapped out. And so I don't know if lemmings is the right word, but it just seems to be that from one week to the next, with not a whole lot of data, the market goes from one strong conviction to another. And right now, that conviction is hard landing, higher unemployment, recession, and a really tired consumer in 2023. Do I buy that? Maybe. I've been, calling for a long time for a relatively soft landing. I do think we'll see a higher unemployment. I do think we'll see episodic credit events, but I don't think that 2023 is going to rival 2008 or 2009. And it wouldn't surprise me at all if in a week or two, after the Fed comes out with their announcements and we hear their remarks, that it's risk back on again, right? The market is really swinging from one extreme to another. And I stand by what I say. I think it's going to be a soft landing. I don't think we've seen necessarily the bottom of where stocks could go. I don't think we've seen necessarily the top of where rates can go, especially on the short end. But I don't think this is a time for either panic or exuberance.
Yeah, I remember when I was a kid, man, it's like some of my friends' mom would like record, soap opera as the world turns on the VCR on top of the TV. And I think what you just described, that's what I feel like this is. It's a week-to-week, day-to-day type of episode-by-episode business that we're in. Even today, I was scrolling the news, and you have several publications saying, oh, the worst is behind us, 2023 looks good, we're going to have a very soft landing, and the economy is going to pick back up. You have others that are saying this is going to be a long recession of recessions or whatever. And it's really interesting just to see how the markets shift day to day, week to week. Obviously, it's going to play out. I think for us, we're in a unique position of kind of seeing it through the lens of the CRE marketplace and through the housing market. So a couple of stats in regard to housing. We've been tracking mortgage interest rates on the 30-year fixed rate for the last couple of episodes. This week, rates continued their fall, so they were down to 6.33%. What's interesting here is that rates have actually seen their biggest 4-week decline since 2008. So I think we really saw the ramp up on the 30-year fixed rate mortgage over the last 6 or so months, and they maybe have started to come down. This quantifies that as the largest 4-week decline since 08. But some stuff that we might be a little surprised by is RealPage had some research put out this week talking about apartment rents across the U.S., and this was the 3rd consecutive month of decline on the rent side. So asking rents fell about 0.6% in November, which was the 3rd largest cut since 2010. That is if you exclude a couple of months right at the onset of the pandemic. And it also is being compounded by a decrease in occupancy. So occupancy's fallen slightly below pre-pandemic levels. So I think those are two things that are not great news for the apartment sector. We don't know how widespread this is in terms of, at every local market, et cetera. But just on the macro, it's not great news. And I think something else that's interesting on the multifamily side that hasn't gotten a lot of attention this year, but maybe as we round out 22, we'll start talking a little bit more about it, is the GSEs, which have their lending limits set by the FHFA, have always hit their caps each year. And this year, they're actually not on track to reach their lending caps. So they're down fairly significantly. It looks like the end of October, Fannie had originated about 54.7 billion in loans. Freddie was about 51.2 billion. And they both, had about 78 billion in allocation. So they're not going to reach the limits this year, it doesn't look like. And their limits for 23 have actually been reduced slightly. I think you talked a little bit about their 23 limits a few weeks ago, Manus, but just to give some context, they're definitely behind the ball relative to where they've been the last few years in terms of origination.
Going back to that RealPage data that you talked about, just to kind of put that in perspective, if I'm not mistaken, in November 2019, occupancy was 95.6%. Fast forward to November 2022, 95.1%. So to your point, below pre-pandemic levels for sure. But I think those occupancy levels were above 97 by a fairly wide margin at one point. So it's not just that they're below pre-pandemic, it's kind of a fairly steep slide over the last 12 months, where this is going. And if this continues, I mean, you could see a 94 or 93 handle in the 2023.
Yeah, and I think what's interesting on that is I think these numbers represent the physical occupancy. So what we would imagine to happen is the physical occupancy, as it continues to erode, or if it does erode, their economic occupancy is going to go down as well. So they're going to start offering free rent concessions and other things on the front end of those leases. So to your point, Manus, if you end up seeing a 92 or 93% occupancy on the physical side, you may be down at 90% on the economic occupancy, which is going to be, a number they haven't seen for some time. So interesting, something to keep an eye on. I still think on a relative basis, asset class to asset class, multifamily is still outperforming. The pipeline for new construction still is really strong, and we're still seeing a lot of transaction activity, but it's definitely slowing a little bit from where it's been over the last couple of years.
So I kind of gave a glass half full picture of what I think 2023 will look like. And what I was really talking about was the broader economy, stock market, company performance, and so forth. Let's take it down to the CRE level. What is the tenor of the CRE market in these days as we head into the final stretch of 2022?
Yeah, I'd touch on, kind of ties into the multifamily transaction activity slowing down, kind of in that same vein. The tenor, generally speaking, is pretty negative. We've seen in the second half of the year issuance slow down quite a lot from the prior years, where in fact, year over year, the issuance is going to be quite a lot lower than 2021. Speaking anecdotally to some of the players in the marketplace at the large boulder bracket banks, they're pretty much just taking the rest of the year off. And you're kind of seeing similar sentiments in the securitization space as, people going into the holidays, they're kind of just coasting and hoping that 2023 is more stable for everyone. And that's kind of just broadly speaking, a little bit dark out there.
So let's scratch beneath the surface on some of your responses there. You were saying, you didn't go as far as to say people are day drinking yet, but I did have a guy I was reaching out to recently who said that's the mantra. He and his fellow participants in the market, by 1 o'clock, their day is done and they are at Smith and Walensky's having a cocktail at 1 o'clock. But I will, kind of scratch beneath the surface here. Is it across all parts of the market, meaning buyers think prices are too high? Prices have not reset enough given the higher rates to make them attractive? Is it the lending side where lenders are pulling back and don't want to make capital available to support purchases? They think the market is inflated, valuations are inflated. Is there anything in particular that stands out as more negative than anything else?
I think the lenders, so kind of feeding into the multifamily transactions slowing down, a lot of Fannie and Freddie's economic activity in the last few years have been fed by the CRE CLO market in multifamily transactions, transitional loan space. So the idea being, you have a transitional loan book, and then eventually you securitize that into a CRE CLO. Those properties get to stabilization, and then that's what feeds into the GSE takeouts. And we're starting to see slowdowns on really at the infancy of that process, where warehouse lenders are coming to these origination platforms and saying, you guys have had advance rates at 80%, we need to cut that back a lot. And once they start doing that, it makes it non-economic for them to continue lending. So that's sort of the sputtering in the marketplace from my point of view on, kind of tying back to the multifamily side. And probably the same thing's happening on the rest of the property types, more generally speaking. And it all stems largely from what I think everyone knows, the pace of rate hikes this year and just the overall movement into base rates have really caused people to take a step back, hit the pause button, see where things really settle out. So I think your comment about looking to see what the Fed does at the next meeting is spot on. I think the dot plots going forward are going to either give people a lot of confidence or add to their concern going into the next year.
Yeah, that CRE CLO market went from negligible in 2018 to really extraordinary in terms of size in the last 2 years. I mean, the growth was really hockey stick shape over the last couple of years, which means there's a lot of loans out there that were made when LIBOR or SOFR was 25 basis points or less. And now we know that SOFR is about 4%. Given all the stuff that's out there, the headwinds that face these multifamily borrowers in terms of lower asking rents, lower occupancy, significantly higher borrowing costs, and costs associated with extending loans. And does this go from a 0% problem, which has been the case for the last 2 years, to a little problem? Or does it go from a negligible problem to a somewhat bigger problem that's going to kind of leave a mark?
I think this is going to be, negligible to potentially a smaller sized problem. I think on a relative basis, multifamily has been able to capture fairly significant rent growth across the board. So the NOI growth on those assets should be measurable. So they should be able to refinance into this higher interest rate environment easier than the other asset classes. The sentiment this week, I was at the NYU Capital Markets Conference. They were talking a lot about the office sector really struggling and some of these other asset classes that have to refinance into this higher interest rate environment. So I think there's definitely more challenging assets than multifamily. The CLO space, as Rob mentioned, those are non-stabilized assets trying to get to stabilization and a takeout. A lot of them are not going to get there. And so it'll be interesting to see what happens there. But I think just at a scale level, it's not going to be something that's systemic. We'll see what happens. On the bid-ask question, Manus, I did talk with someone from Cushman & Wakefield this week that was saying they're seeing about a 30% delta between bid-ask on the sale side for transactions, and likened it to the public REIT space, where you're seeing a lot of the public REITs trade at about a 30% discount compared to where they were at the beginning of the year. So there's definitely a delta, I think, between the public and private markets in terms of valuation, but their position would be that the private markets are adjusting more rapidly than maybe appraisal values and other things are in the space. And so I think that's something to keep an eye on the next 6 months, that we may see an increased or a more rapid, acceleration of value decline than what we've seen post-pandemic.
I think Sternlicht was at NYU. Were you at that particular conversation? What was his tenor?
Yeah, so it was very interesting. Barry Sternlicht was one of the keynotes at the conference, and it's interesting when he's on. He's been on the news a lot lately on CNBC and other broadcasts. Some of his talking points have been directly tied to the redemption limits on some of their, private non-traded REITs. But I'll get to that in just a second. I think just generally, he's unique in the sense that his company sits on both sides of the ledger. So he had a very interesting perspective in the sense that while he's adamant that the Fed's increasing of the rates is very negative to the valuation and the equity, the operation side of his portfolio, it's actually not a bad time to be on the debt side or on the lending space. And so he was definitely bullish on pivoting some of their strategic initiatives to be more on the debt side than on the operation side. And so he had some comments there around that. He had some thoughts around negative leverage, thinking that higher cap rates on properties are a warning sign, and that if you were to give it an example, they're flashing dark orange, maybe even red. Back to the redemptions on the non-traded REITs, he was definitely talking his book. So, you have to understand where he sits in the discussion. His firm is one of the firms that had to put a stop to that. But he took a technical approach and basically said that these are not hedge funds, that they can't liquidate properties overnight at attractive prices. They have to manage liquidity. And in the operating agreements or in the documents, basically, they have a redemption limit built in of 2% per month or up to 5% per quarter. And once they hit that limit, then they just shut it down. He was basically saying it's a non-story. I think we've probably seen a bunch of other articles and a bunch of other people's takes that think there's a little bit more there than what he was alluding to. But I think his position, makes sense in the form that it is just a technical at this point, that they have a limit set and they hit up against that limit. And so they're going to stop that. So we'll see what happens. I think Blackstone CEO Steven Schwarzman had a similar discussion around elevated redemptions at his company's fund. He said they had just basically a few large players that made some redemption calls that put them in the position to have to stop it with the withdrawal. So, interesting take. I think we need to let this play out a little bit more before we can really form an opinion on what this means for the market broadly. Interesting insight from someone that's really close to the activity.
Yeah, I did notice that he said on the other side of his fence, which is the special servicing part of his firm, which I think they're the biggest special servicer in the country, if I'm not mistaken. I saw it quoted in an article that 50% of the new additions to their special servicing book have come from offices. So that is a part of the market that really, not surprisingly, is starting to show more cracks.
I mean, some of the interesting anecdotes that we've referenced in the past is just seeing how many people are coming into the offices just physically badging in. And I think that's still pretty depressed versus pre-pandemic. It kind of follows, in addition to higher costs of capital, CFOs looking for places to cut expenses. It makes sense that, if people aren't going to come into the office, it might be the first place to go.
Yeah, I'll give you a data point that I noticed today. It's a real micro data point, but I was just kind of researching some loans because that's what I do for sport. Some people fence and other people play bocce. I go through and look for loans and data and so forth. It makes me very interesting. I must say I'm a whiz at a cocktail party, but the loan I was looking at was originated in early August when the 10-year treasury still wasn't that high. It was only 282. And this was a big loan. It was about $80 million on an office in a major southern US city. And so I went back to see what that implied spread was that day, given what the coupon was and what the treasury rate was on the day it was originated and so forth. For people who are looking for financing benchmarks, this loan was done at 300 over the curve at that point. And if you're looking at the treasury now, I mean, the 10-year isn't at 425 anymore, but if it was at 425, a similar loan would be done at 725 now, right? I think the 10-year is probably more like 350 now. So, but you're still talking 650, and leverage on that loan was 59 LTV for like a 165 DSCR. A year ago, that loan would have easily gotten 74% LTV, right? It would have gotten, a lot more leverage than it did. And I put that out there for borrowers who are 12 months away from refinancing as to, what they might be looking at as a market that they're trading into when it comes time to refinance their thing.
Definitely looking at that space might be helpful to look at historical figures and where those things have trended in the past. And I know we've been developing some data around that internally. So if the listeners are interested, please feel free to reach out.
So we've been talking about lenders and lender sentiment. And while Q4 bank earnings are still more than a month away, our team wanted to get an early read on bank performance. So we consulted our capital adequacy stress testing model with our own Matt Anderson, who looked at what it would predict. And we've got a high level overview, but if you're interested in the details, you should definitely reach out to us.
Yeah, Martha, we ran the model and it looks like we're projecting encouraging year-on-year comparisons for earnings in Q4 of 22. Slight increase in Q4. This is on the heels of significant drops in Q3 and Q2. So higher revenues are driven by higher net interest income. Those are the main source of improvements and are being helped by expected moderation in expense growth. So as you mentioned, you can get the full report, reach out to us. We'll be happy to share that with you, but it seems like encouraging news on the whole.
Okay, we got a lot of stories we're going to try to plow through. Let's start with retail, where we've got some good news to start us off with.
Yes, it was a good week, I have to say, and it's, I guess, kind of a piece, if you will, that the mall space, which is kind of the really high focus area for people that look at distressed assets and so forth. And ever since 2017, we really thought that a lot of these mall loans would go into default. More and more are muddling through, if you will. This week, we were tipped off by a TreppWire reader. Thank you for the tip, by the way, that during Macerich's Investor Day call, they put out a lot of upbeat thoughts, not only at the macro level, but also the micro level. They talked about occupancy getting back to pre-pandemic levels, more pricing power than at any time in the last 2.5 years. It wasn't overly exuberant, but it was certainly upbeat. Let's put it that way. And they gave some updates on 3 assets that they have, in my opinion, all of which, well, some of them were very strong assets. They probably weren't going to run aground, but some of them were probably candidates for jingle mail. And instead, each one is either going to be paid off or has been extended. The first one is the $400 million Scottsdale Fashion Square loan, 1.7 million square feet in Scottsdale, Arizona. It backs a 2013 single asset deal. The note is scheduled to mature in 2023. Macerich has indicated that a new $700 million loan, so 42% above the balance of the previous loan, a 5-year loan, has been arranged. A lender has been selected, and the deal should close in Q1 2023. So that's, a terrific green shoot. I would have to think that if the loan on the property is up 42%, then valuation is probably up 42% as well, if not more, on the Scottsdale Fashion Square. In Santa Monica Place, this is a 500,000 square foot regional mall in Santa Monica, California. It backs a 2017 deal. That loan was already extended once for 36 months. That extension ends this month. Macerich said a new extension is on the 2-yard line. That's my words, 2-yard line, but should close in the next week or two. So a new 3-year extension for that loan should be coming out. Again, this is a case of Macerich keeping the asset, fighting for it, and trying to make it work. And then lastly, Green Acres Mall in Valley Stream, Long Island. That's a 1.8 million square foot property. Macerich had a maturity date for that loan in 2021, early 2021. It was extended twice to February 2023. Macerich on the call indicated that a new loan was in the process of being arranged. So 3 nice outcomes from 3 really big mall assets around the country. So thank you for that tip, and I'm really happy to report that positive news.
Well, that last one's the place to be for sure.
You're hanging out at malls, Rob? You're retracing your teenage years? Are you going to Lids, followed by, Annie's Pretzels, and, you got your Skechers on, you're rolling around in those sneakers with the wheels on the bottom?
I've seen those at malls, and I've almost gotten taken out by one of the kids on them. But no, I was referencing the show Green Acres from way back when.
Oh boy! Wow.
There we go. And Albert, right? And Zsa Zsa Gabor, or was it Ava Gabor?
Well, they were sisters, as you know.
Yes, but they didn't both play on the show, did they? It was one or the other.
Yeah, they did.
And who's the pig? Orville the pig or something?
Now you're really digging into the files.
Yeah, so you could tell that in the few moments I have when I'm not trying to keep my cocktail party banter up, checking out loans, that I'm watching Me TV and some of those things from the 60s.
Hey, over the air is still free, so that's why I do it.
So we got a couple more green stories.
Yeah, I'll go into those real quickly, run through them. In Connecticut, a 260,000 square foot grocery anchored retail center in West Hartford was purchased by Edens for $76 million. This is a Target anchored property. Commercial Property Executive had that story. In New York, where street level retail has been laboring for a long time, even pre-COVID, with plenty of boarded up shops and falling rents in Soho. Adidas renewed its lease at 610 Broadway for 10 years. So that's a positive sign there. And lastly, Newmark had arranged a $137 million sale of 3 shopping centers in Los Angeles. That comes from Shopping Center Business. The 3 properties total, I guess, about 400,000 square feet and sold for 137 million.
Yeah, I don't want to rain on your green parade, but there was a crabby story this week from the Walmart CEO, Doug McMillon, who said thefts could lead to price hikes and store closures. They say it's a problem that if it's not addressed, it could be something that impacts the number of stores.
I think that comes on the heels of Target CEO basically with the same sentiment. I think the number for them was like 400 million on this year that they had absorbed through theft. And so, yeah, that's a growing story, I think. And, you know, if it leads to store closures, I think that could become something that we want to keep an eye on. I hope that we can get that remedy before it comes to that.
Turning to office, we saw a story that one of New York's office developers is raising a big fund to acquire office buildings for conversions, something we've talked about before. And mostly the conversation on our pod has been in the theoretical sense, but lo and behold, here's a real one.
Yeah, so we, at the conference this week, Larry Silverstein was actually there. He's 91 years old, did a little bit of speaking at the conference, and it was really great to see. He was actually recounting his very first commercial real estate transaction, you know, some decades ago. So it was really great to hear from somebody that's really transformed a lot of the New York real estate marketplace. They talked a lot about the work they've done at the World Trade Center and the buildings they've built there and their future plans. But to your point, Martha, one of the topics of discussion was this $1.5 billion fund they're raising, targeting what they call obsolete office buildings, with the idea of repositioning those as residential and multifamily use. What was interesting is that discussion dovetailed from the mayor's, keynote at the conference, where he was saying the city of New York is going to become the city of yes as it pertains to real estate development and redevelopment. And then the Silverstein folks were talking at length about the need for public-private partnership in order to make this financially feasible, and that there would be some sort of an affordable housing component. I left that session feeling a lot more bullish on this opportunity. I think what this signifies is you have some major players with connections in the city that are bullish on this to the tune of about 1.5 billion. They feel like there's some real actionable opportunity here. In spite of what we've seen broadly, the market has been, tepid on the reality of doing this. Like, I think CBRE had a report that said maybe only 3% of office buildings would qualify financially for this from a feasibility perspective. So it'll be interesting to see what happens. It bodes well for the city if they can actually strike some sort of public-private partnership. Their CEO, Marty Berger, actually said they have a list of 8 or 10 criteria that are needed in order to identify those buildings. So I'd love for him to share that with us and for us to generate a list for them using our Trepp data. So if you're listening, feel free to reach out. We're more than happy to provide you some service there. But interesting story, more to come. RXR was another developer there. They were also bullish on this idea. So some of the major players in Midtown and Manhattan broadly seem to be focused on this as an objective heading into 23.
I guess you could say San Francisco is the city of no. Elon Musk got his hand slapped for putting some mattresses in his office so his beleaguered IT staff could sleep at the office rather than commute in San Francisco. Perhaps you saw the story today that Miami has opened their arms to Twitter. They said to announce publicly that Twitter would be welcome in Miami and that Musk should shutter his San Francisco headquarters there on Market Street. We should mention, we had a listener ping us, I guess, on Twitter or maybe on email, I forget, talking about that Twitter building in San Francisco. The Real Deal in San Francisco did a real big piece on this. I'm not sure I could add anything beyond what was in that piece, other than to say this is one of a couple of dozen big offices we will watch over the next couple of years. Between San Francisco having so much sublet space, between the loan maturing this month and with Twitter having leases that end between 2026 and 2028, this is exactly the kind of office that will really, really struggle to get refinanced. There's just an awful lot of hair on this. And if you're interested, we're happy to share our data with you on that particular office. If you want to see some of the data that went into the real deal story, we're happy to show you when the leases expire, the net operating income, occupancy, et cetera. So reach out to us if you're interested. And thank you for the ping.
Okay, we got a couple more stories we'll try to cover in office. Take us from Denver to Chicago. So hopefully we can cover some of these.
I'll try to talk on the 1.5 speed. And so if people put on 1.5, what will that be? 2.25? Here we go very quickly. More crabgrass in Denver. Last week, we said that Robinhood was putting space on the market. Now it's ADT. They have put 123 square feet of space in Aurora out for sublease. That property backs a 2017 loan. In Chicago, public relations company Cision is downsizing its headquarters and moving to the West Loop. That story comes from Crane Chicago Business. The Denver story, by the way, came from Denver Business Journal. Also in Chicago, in Continental Towers, in Rolling Meadows, Panasonic, the second largest tenant at the property on a lease that ends this month, will be vacating, putting more pressure on that property. DSCR is already below 1.0x at that property, and occupancy is 63%. In San Francisco, Laura Waxman reported that Pinterest is not going to renew a lease at 410 Townsend Street. Pinterest has a lot of, or is it Pinterest? I guess it's Pinterest. Pinterest, there we go. I always pronounce that incorrectly. That firm has a lot of space in San Francisco, so it looks like a mild pruning there. A mixed green in Houston, in the Houston area. Cousins inked a huge lease with Apache Corp, according to the Real Deal. The firm is upsizing at Briar Lake, where they're going from 211,000 square feet to 330 on a lease that goes to 2038. So that's the green part of this mixed green story. The crabgrass part of the story is they have 500,000 square feet of space at 3 Post Oak Central in Houston, if our intelligence is correct. And we assume that that's going to be vacated. So mixed green in Houston. Lastly, also in Houston, this is solid green. Taylor Williams of the Real Estate Business Journal. The Wood Group has renewed for 225,000 square feet at Westgate 3, which is part of the Park 10 Business Center. And that's all I got.
Just a quick comment on the mixed green Houston story, Manus. I mean, that's a 14-year lease for a really large size square footage office. So, we haven't seen that. I did see some stories this week that said landlords are really having to pony up TIs to get tenants to sign on to those longer term deals. So tenants were trading TI dollars today for longer term. So it'd be interesting to see on that deal if there was something that would marry up to that thesis. But a 14-year office lease in Houston in today's market, I think everyone's clapping pretty big for that one.
Moving on to hotels, a sector that has demonstrated resilience. We've got a number of stories that highlight that.
Yes, a lot of green stories this week. I'll try to run through them just as quickly as I could. I know Rob and Lonnie want to do their Christmas shopping before this podcast is too long in the tooth. Green Shoot, MGM Grand Mandalay Bay. Blackstone has sold its 49% stake. The sale price, if grossed up as if they were selling 100%, would value the hotels at $5.5 billion. Real positive sign for both the CMBS loan backed by the hotels. On the value side, the hotels were valued at $4.6 billion in 2020. So what we're seeing is a 20% jump in value, even though rates are considerably higher. So the bonds that back this loan now have more credit enhancement, if you will, than they did 2 years ago when the loan was made. Beyond that, this loan was made just before COVID emerged. It was made in early 2020. In March, COVID came out in full force. As a result, it took a really long time for this loan to be fully distributed. I think at one point people were saying, what's going to become of a loan like this? Will people ever travel again? And now we have something which is at a value 20% higher than where it was in 2020. Great stuff. In Jersey City, a $100 million loan was assumed as part of an acquisition. Taconic and HEI Hotels and Resorts have taken over the loan from Hyatt Hotels Corp. And Veris Residential. They will assume the $100 million loan. Why did this catch my attention? Well, the existing loan is still underwater from a DSCR point of view. In H1 2022, DSCR was still negative, even though occupancy had climbed back to 62%. The fact that Taconic and HEI are jumping in, taking on this asset and assuming the loan means that for some period of time, they're going to be reaching into their pocket to fund these losses. And to do that in the hotel market, I think is a terrific green shoot. So good on them. In St. Pete Beach, the Serrata Beach Resort has been sold for $207 million, 382-room hotel. This was reported by Jay Cridland of the Tampa Bay Times. This property was sold for $108 million in 2017. So almost 100% appreciation in value over about 5 years in a hotel market that was just obliterated for 24 months.
Industrial, which has been a very strong performer over the last several years, is showing a couple of signs of potential cracks.
Yeah, I'll be interested to see what Lonnie and Rob think about these, if these are one-off episodic things, or if this is, the market kind of reaching saturation in some areas. The first one is Matt Christie of the Indiana News. He says FedEx is closing a West Side Indianapolis supply chain facility that will close permanently in January. And in the Kansas City area, this comes from Andrew Voppel. I hope I'm pronouncing that correctly. A 1 million square foot distribution center that is currently occupied by the Coleman Company, which I think is camping gear, has been offered for sublease. This is in Gardner, Kansas City, that is available. And we did see reports that, I believe this was in Florida as well, that Amazon is making a facility available for sublease as well. So is this the beginning of a leveling off, or is just this, a healthy turnover in the market? I don't know. What do you guys think?
Well, I think on FedEx specifically, I know their earnings had been down, and that seemed fairly volatile for them. I think UPS on the flip side actually has been outperforming. So I wouldn't be shocked if FedEx says that they're definitely going to be closing some locations or not renewing leases. So I don't think this on its face is really, anything that we should be concerned about. But I think generally, we definitely have started to see a little cooling in the industrial space, but I think that's expected. You basically had, like Amazon said at one point, they had 20 years worth of growth and expansion in about an 18-month period. So, that's not sustainable. So I think it's something for us to keep an eye on, but I don't expect anything, in the near future where we're talking about doom and gloom stories for the industrial sector.
Yeah, I agree. I think, we had seen Amazon pull back a little bit on their expansion plans, but they've expanded so rapidly that it kind of makes sense that they've potentially overshot a little bit. And as we mentioned at the top, it was, potentially the consumers are starting to feel a little bit of strain with inflation and higher rates on their credit cards. So distribution could be feeling that a little bit, but that'll a slow play out. And I think, the run up in valuation in that space has gone so far that potentially a healthy pullback is in the works, but I don't think it's going to be anything catastrophic.
So shout outs, we have a lot of shout outs in the last week, so I will try to run through them quickly. Josh C, Kevin T, Sean C, all loved our show, and we're looking for some life comps data. David L asked for some information on our risk management webinar that was last week. Gene KB wanted Manus to talk about the Twitter building, and I think you did. So well done.
I did, but like I said, if there's more questions about, come to me, and we're happy to share either the data or our thoughts about it. I didn't mean to give it short attention today.
And Tony W on LinkedIn commented on episode 171, where we talked about the unicorn. He said Trepp does it again with their excellent podcast on commercial real estate finance markets and a rarely seen unicorn. And if you don't know what that is, you'll just have to listen to that episode to know what it's about. Omar E, he wasn't awake when our pod dropped, and it was pretty late last week, but he loved the episodes.
Got to give a shout out to ex-gal Haley for going through the effort to edit that one well past midnight. I think we'd finally dropped that about 1 o'clock in the morning, the latest we've ever done it. So a shout out for her as well.
And Deborah Black Eagle, congrats for our top ranking stats, which we talked about. Mark S. Rank D tweeted at us. He is a listener of the podcast and was interested in learning more about some of the things we do. I'm sure we're going to have somebody talk to him. Eileen G wanted to say that she was not surprised by our stats. So thank you for that. Brad S. emailed us. Hudson H. commented on the Airbnb story that we talked about last week. And Hussein W. loved the podcast and wanted a report that we talked about. And I know, Lonnie, you had a couple.
Yeah, so it's really great. There's no better feeling than going to these conferences and having people come up after my panel and say, hey, love the podcast, listen every week. So I wanted to give a few shout outs to some students and some CRE practitioners that came up and introduced themselves to me at this week's conference. So Antonio L., he's a master's student in real estate at NYU, said he listens every week. So I wanted to give him a shout out and tell him thanks for listening. And then Yoni, Reed, and Eli from Trez Capital. All three are avid listeners and said they've spread the word around their office to get more people to listen to the pod and they enjoy the episode. So I wanted to give those three guys a shout out. It was really great to meet all of you. And we really appreciate you listening to the pod.
Manus, in the interest of giving you something to talk about at your next cocktail party, the most searched term on Google this year is?
Elon Musk.
No, it is Wordle. And I know you're a Wordle fan, the little Wordle.
I love Wordle. I love Wordle on the phone. And I have to say that I don't like, tooting my own horn too much, but I think I'm really, really good at Wordle. A little bit of inside baseball from back in my Trepp youth is that during lunch, we used to often play Boggle. There were 8 of us that would sit around the table and we play that game with the cubes and you'd spell all the words and so forth. And I'm much more into Wordle than pickleball. I got to say that.
Had to say it. You had to say it. So with that, we will close. Thanks to our producer, Haley Keenan. Rob, thanks for joining us today. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.